delighted to say to talk us through the numbers, Lard Friese joins us, the CEO of Aegon. Sir, always a pleasure seeing you. Thank you for joining us. So how would you typify the most recent numbers, sir?
Yes, good morning, and thank you for having me back on the show. Today, we've announced a solid set of half-year results, with our operating result of the company up 3%, with operating capital generation up 13%, with a good sales momentum in key areas, strong capital positions, which allow us to increase our interim dividend by more than 25% to 40 cents per share. In addition, we've made a lot of progress strategically with the transformation of Aegon. We have been able to close our large transaction with ASR in the Netherlands. We have closed also the divestment of our Central Eastern and European business. We were able to make acquisitions in the asset management area, where we strengthened in the last half year our CLO platform. We also extended our asset management partnership with La Banque Postale Asset Management in France. We've strengthened the UK business with the extending of the partnership with Nationwide. So all in all, we're making a lot of progress also with the transformation of the group.
Yeah, I'm going to focus on a positive, actually, which is unlike me normally. But, I mean, this big increase in Transamerica new life sales, driven by mid-sized retirement plans, increasing almost 70%. Obviously, you've got a very large set of agents for WFG now as well. Do you want to go into some of the detail on why the US is such a key market and doing so well?
Well, the U.S. Transamerica is really an icon of the life insurance industry in the United States. And we have launched plans a couple of weeks ago in London on our Capital Markets Day on how we wish to grow that business in the coming years to become the life insurance and retirement franchise for middle market America. This is a very large, unserved part, relatively unserved part of the population in the U.S. and gives a unique opportunity for us to grow. We have indeed a very large network of agents, WFG, 70,000 agents, which are growing in numbers. And they are actually the motor, the driving force behind the 17% sales growth that we have seen in the traditional life insurance business in the first half of the year. Our second prong in middle market America's market segment is our retirement business, which we also focus on the mid-market of retirement plans in the United States. And indeed, the first half of the year was very strong, with more than 30% uptick in sales, which, and I must admit that as well, of course, was powered by a very large deal that we did on a pool plan of $1.7 billion in new written sales. So that was quite good. But we are on our way with our growth plans for Transamerica, and we are in fact, making good early progress there. Now, the net loss that you were referring to, which I still owe you an answer for in your opening comment, is actually connected to this. Because at the Capital Markets Day in London, we announced that we would invest in that business in the United States to ensure that we can fund that growth plan for the coming years. And those investments that were announced at that point in time are now showing up in our IFRS results, and as a result, we're posting that net loss. But again, our operating results are very strong, and indeed, the commercial momentum is there.
Lard, I can certainly see the operating result up, much firmer result this year versus same time a year ago. And speaking of comparing and contrasting, it feels as though there's been a lot of self-help measures through the business at this stage. But what does the operating environment look like this year, say, versus last year?
Well, the operating environment, let's first talk about global growth. Because we are an international insurance and asset management business with businesses ranging from the US, the UK, China, Brazil, with insurance, retirement, and asset management product lines. Global growth, I would say, is at this moment like running in the mud. So there is progress, but it's step by step. And China certainly is seeing issues with its economic growth path, where the first quarter was decent, but the second quarter results that came out on economic growth were not good at all. And as a result, we saw investor sentiment weaker, and that has been, by the way, also the explanation for the fact that we saw 600 million of third-party outflows of our business in China on the asset management side. On the economic growth path in the U.S., obviously, we're still seeing a decent economic growth, also economic growth in other areas, but in Europe it's lacking a bit. And then, of course, it's all about how the inflationary path and the response of central banks is going to lead to, let's say, a hopefully soft landing of the overall economic growth path. But that still remains to be seen. And certainly, I think the developments in China are going to be quite important for that.
You certainly paint an interesting picture there about how complex the environment is. When it comes to China...
We'll remain focused.
Well, we keep on seeing these numbers flow out of China. They are challenging from the property side, on the debt side, the growth side, deflation, concerns about what sort of spiral we could be seeing on prices at this stage. What's your biggest fear around the Chinese market?
Well, growth and making sure that it is a very large economy. It's important that we see economic growth in China, and that it's supported by policy support from the Chinese government, where there are some real doubts at the moment whether that's really going to happen. The Chinese government has had a clear target of 5% growth. In the first quarter, they made good progress, but the second quarter is clearly showing they're not making it, and a lot needs to happen to reach that objective. So what we need is China to show solid, robust growth, which is important for the overall growth of the global economy.
Can I ask you quickly, too, about the US 10-year yield? We saw it spike yesterday. The market's concerned we've gone right back to 2008 levels. What's your view on the pathway for those long-term yields stateside now?
If we look at rates, let's first look at labor markets, economic growth. Economic growth in the U.S. is still very decent. What we do see, and that's quite encouraging, is that while labor markets are strong in the U.S. and especially in the U.K., in Europe, you see there is moderate cooling down, if you will, of the growth of employment. And that is hopefully going to help the inflationary pressures. It's a bit of a toss coin for what the ECB will do when it comes to interest rate hikes or not. I think the market is pricing in for the U.S. that interest rates will likely not be hiked in the near term. So we need to see how that all will weave into the overall economic growth path in the U.S. and what it will mean to rates. There is some speculation and some expectation that in the course of 2024 we could in fact see a reversal of the 11 rate hikes that we've seen so far, and we could see some maybe more easing measures. But for the time being, I think it will be quite tight.
Lard, thank you for putting that on the record. We appreciate your thoughts today. For joining us on the back of numbers, Lard Friese with us, the CEO of Aegon.